the midweek edition of Business Morning on Channels Television. Welcome to the program. I'm Ini John Mekwa.
And I'm Ladi Williams. Thank you for joining us. Let's take a look at what's in the news. Oil prices fell today on future demand concerns after data showed that China's first half crude imports dropped. We're still holding a near one-week high amid concerns about supplies as the world recovers from the coronavirus pandemic. Brent crude was down 8 cents at $76.41 a barrel after gaining 1.8% on Tuesday. West Texas Intermediate was off by 13 cents at $75.12 a barrel, having jumped 1.6% in the previous session. China's crude imports dropped by 3% from January to June compared with a year earlier. The first of such contractions since 2013 as import quota shortages, refinery maintenance and rising global prices curbed buying. Disagreement over supply policy within OPEC Plus led to the end of talks last week on boosting production without an agreement. Crude inventories declined by 4.1 million barrels for the week ended July 9th, which would be their 8th straight weekly fall.
Meanwhile, the International Energy Agency says global oil markets are likely to remain volatile following the recent breakdown in output talks between the Organization of Petroleum Exporting Countries and its allies, that's OPEC+. In its latest monthly oil market report, the IEA says that energy market participants were closely monitoring the prospect of a deepening supply deficit if a deal was not reached by OPEC and its non-member oil-producing allies. The group abandoned talks last week, which would have boosted oil supply and not made progress in resolving the dispute between OPEC kingpin Saudi Arabia and the United Arab Emirates.
And back here, the Trade Union Congress of Nigeria has expressed its disapproval at the planned move to limit fuel imports to fuel operators in the oil and gas industry, saying it is monopolistic and a deliberate attempt to frustrate the challenges the petroleum industry bill is intended to solve. According to a statement by the workers' body, the market should be left open if the government truly wants to be sincere in addressing the problem of the sector. Congress notes that the country cannot afford to continue toying with the oil and gas sector as it remains the only major source of foreign exchange. The labor leaders urged lawmakers to rise up and provide true leadership instead of serving the interests of a few.
Well, according to the National Bureau of Statistics schedule, inflation figures for the month of June should be released tomorrow, the 15th of July, 2021. The last two releases beat the projection of economists. Remember that?
Oh, yes, I remember.
Nobody saw it coming.
It was quite a shock.
Yeah, well, will it be the same this time around? Well, let's have the senior analyst at AfriInvest Securities, Damilara Ashimiyu, will talk to us about that, his projections, expectations, and the possible impact. But that'll be after the break. Join us. Nigeria's inflation rate dropped to 17.93% in May 2021 from 18.12% recorded in April 2021. The drop in the headline inflation in May was the second consecutive month this year, although it beat the prediction of analysts and economists. It's time for inflation figures again, this time for June. Financial Derivatives has predicted an uptick to 18.1%. But what is AfriInvest forecasting? Damilare Ashimiyu, senior analyst at AfriInvest Securities, is here to tell us. Hello, Damilare. Good morning.
Yes, good morning.
So have you guys done your prediction for the month of June?
Absolutely.
What is it and what factors did you consider to arrive at your forecast?
Yeah, thank you very much. On year-on-year basis, we expect the headline inflation to moderate further by about 20 to 23 basis points to around 17.7%. And we expect this to be driven by a sharp moderation in the food inflation subcomponent. We expect the food inflation to moderate by about 50 basis points to 55 basis points to around 21.7%, while we still expect the core inflation year-on-year to ascend by about 30 basis points. Now, what we factored in for the year-on-year projection is the fact that we took sample of, average prices of major food items across major states, and we tried to compute our own CPI and look at the percentage change compared to last year. And we figure out that there's still base effects, are applicable to food inflation. What I mean is that between April and June last year, that was when April last year was when 5 major states in Nigeria, Lagos, Ogun, Kano, FCT, as well as River State were on lockdown due to COVID pandemic, and there was a restriction of movement. So between April and June last year, food inflation rose, about 62 basis points, 24 in April and May, and 14 in June. So that created a large base for the food inflation. So not minding the fact that food prices have not really moderated now in the real sense, and that's where the month-on-month analysis comes into play. That high base effects will affect, from our estimate, will affect the year-on-year change in food price inflation. And for that reason, we expect it to moderate. And given the fact that food inflation component accounts for 51% of the CPI basket. So because of the weight it has and the level of base effect that we have established, we feel that it is significant enough to drop the headline inflation down by between 20 to 23 basis points to 17.7. However, on a month-on-month basis, we expect headline inflation to rise by about 4 basis points to 1.5. And we believe this will be driven by both the food and core inflation. And I'll provide better context. On month-on-month basis, from our sampling, we observed that a number of food items, staple food items, had their prices increased in June relative to May. And we believe that will affect month-on-month reading. And also, before June, specifically on May 28th, the CBN adopted a new official rate, the FX rate of 410 to $1. And June was the first major month that this policy, was felt. And as that policy was made, or as the CBN adopted the new rate, exchange rate in the secondary market also reacted to that, because prior to June, exchange rate in the parallel market, traded below 490. And by virtue of that policy alone, exchange rate in the secondary market rose to 503 at the end of June. And as of yesterday, it was 505. So if you look at it, there's what we call pass-through effects. Now, when manufacturers or investors who need dollars to perform their transaction, maybe to import material for their production, buy dollar at expensive rate, there's no doubt they will, buy dollar at expensive rate to procure, be it resources from outside the country or machinery to use for their production. There's no doubt that they will pass through the cost effect on consumer. And this, reflected in price of some services item that we also looked into in the month of June. So basically, we observed that food prices increased slightly, and it will affect food inflation on month-on-month basis. And the exchange rate devaluation, so to say, will also affect the month-on-month rate for core inflation. So basically, on year, the headline inflation will moderate. For month-on-month, it will ascend because of the reality of what happened in the month of June.
Okay. Well, a rise is not what I really want to hear, but the report shows a decline in food inflation, and yet it says the rise in the food index was caused by increases in prices of bread, cereals, soft drinks, and other tubers. Considering that these are actually staples, what does this imply?
So how the CPI index, which is used to measure inflation, work is this. It actually looks at the rate of change, in the average prices of the items that are contained in the food basket in the present period compared to, if you're measuring year on year, compared to the corresponding period the prior year. For instance, now, in June, if the rate of change in the average prices of both food and non-food items, is weaker, even if the change is the change is an increased change. Or if the rate of change is weaker compared to the rate of change experienced the corresponding period a year earlier, when, let's say, prices declined, the inflation figure you are likely to get will come down, because the base effect is just like having a bigger denominator to work on a small numerator. So what it implies is that, and that's why I mentioned earlier that the month-on-month reading is actually the major thing to always consider when you want to compare the present month or the immediate past month to the month before it. The month-on-month inflation gives a more decent reading of what actually transpired in a month relative to the month beside it. But there are a lot of, a number of things that can make the year-on-year not really paint.
Okay, so we seem to have a bit of a glitch with Damilare there, but he was talking about, because remember when we had the last two, the release of the last two inflation figures, and a lot of people could not understand why you would say inflation is moderating, and yet when we go into the market, when we go to the roads, we see transport fare, we don't see a moderation in prices, and he's just trying to say, well, when you look at it from year on year, and I think a lot of analysts have tried to put that in perspective. When you compare the level of increase from last year to this year, then it's going down. But when you talk of month to month, that means you're comparing, for instance, in this case now, the figures we're expecting tomorrow, you're looking at from May to June, from June to July. We're comparing price in that perspective. But I bet Nigerians
we should be giving our own projections too.
I wish you all the best. But I bet what Nigerians will really want to see is a figure that captures what they are feeling.
The realities, exactly.
Yes, the realities that we have at the moment. I mean, because I don't remember before
I don't remember when the price went up and actually, came down.
No, but
prices just keep
going up. But I don't even remember before now when we had to start giving explanations as to why the figure is going down and why we're surprised.
We should be able to see it.
And no economist or no analyst actually got the prediction or was close to it. Everybody saw inflation rising and yet it's moderated. Anyway, I think we have Damilare back now. Hello, Damilare. Can you hear us?
Yes, I can.
Okay, so we lost you there.
You can conclude your talk.
No problem, I'm back.
Okay, all right.
So what I was saying then is that...
Go ahead.
So basically, CPI is just showing the rate of change in one period to the other. So it's always good to analyze the performance or the trend in the previous month by considering the month-on-month index. Thank you.
In all of this explanation, I mean, for the man on the street, it's a lot of story and it's just grammar, But what's happening to disposable income? Has it moderated? Has it gone up? Because if we have to give this much explanation for the inflation figures, what's going on with the disposable income?
So there are three questions that need to be answered to establish whether the disposable income of an average person has improved or not. The first question is, has the source of income, or let me say the wage of the common man, has it increased, I mean, between the last month and now? For what I know, maybe except for individuals who, might have gotten promotion in their place of work, especially those that are working in private or public sector. On the national scale, we have not had another upward review in national minimum wage. So it then means if you're looking at disposable income from perspective of increase, because if you hold every other variable constant, the only way your purchasing power can improve if we hold every other variable constant is if your wage increase. So if you have an increased wage and prices are still unchanged, then your disposable income is better. Now, the next question to consider is what has happened to inflation rate? So if you hold every variable constant as well, your wage is unchanged and every other variable, except for prices of commodities. If prices go up, even if it is by just a basis point, it then means the purchasing power of the economic agent has weakened. And the third question to answer to establish whether the disposable income of an individual has improved is what is the trend in the exchange rate? And like I mentioned earlier, before June, the official exchange rate was $3.79 to $1. In the parallel market, it traded about $4.40 to $4.80 or thereabouts. But in June, CBN adopted, or let me say late in May, CBN adopted a new official rate of 4.10. And by virtue of that, the secondary market also reacted, reacted such that the value of Naira also weakened in the secondary market. So given the fact that a common man, goes to the same market that a rich man goes to, the producer of that commodity will surely pass through that burden to final consumer. And that's what I explained earlier as a pass-through effect. So if I used to source dollar at 379, let me use the official rate before, to bring in goods that everybody can, patronize me for. And now I have to spend $410 to get $1. So that means the cost of my good will go up. And by virtue of that, given the fact that we have assumed that the wage of a common man has not increased, neither has inflation rates drop. Of course, inflation will not drop if exchange rate weaken. So, looking at those three factors, which I try to shape as questions, I really don't think the disposable income of an average person has improved between the last inflation reading in May and that of June that we're expecting.
All right, Damilare. Well, you are predicting, AfriInvest, that is predicting that inflation will moderate to about 17%. I think we just have about 24 hours.
17.7.
17.7, yes, that's what you said. About 17.7%. So we have about 24 hours to see if your prediction is going to come true. But thank you so much for sharing your thoughts with us ahead of June's inflation, which we expect to be announced tomorrow by the NBS. Damilare Ashimiyu is a senior analyst with AfriInvest Securities. Thank you so much and enjoy the rest of your day.
Thank you.
So after the break, FX Commodities Market is next. Just stay with us. It's Business Morning on Channels Television.
Welcome back.
On FX Commodities Exchange in the week that ended July the 12th, the number of contracts reduced by almost 100%. Michael Martins, portfolio manager with FX, always does a good job clearing the air on activities on the exchange. So, Michael, over to you. Good morning.
Michael, can you hear us?
Yes, Ladi, I can hear you quite clearly.
Okay, so take us through activities in the markets for the weekend of July the 12th.
All right, thank you very much. So if you look at the commodities market summary, the total value of transactions traded on the exchange fell by 98.60% from around 23 billion to close the trading week at just over 322 million naira. And also the total number of contracts traded on the exchange fell by 98.49% from around 542,000 contracts to close to trading week at just over 8,000 contracts. The number of deals also fell by 39.47% from around 38 deals to close the trading week at just 23 deals. The AFEX Commodities Index went up slightly by 3.05% from 476.02 basis points to 490.56 points rather. The AFEX Export Index also went up by 5.62% from 170.02 points to 179.58 points. With regards to the volume of transactions traded on the exchange, we generally saw a lower volume across board, with the biggest changes happening with maize falling from 311,694 contracts to close the trading week at 2,669 contracts. With cocoa and sorghum, we also saw a decline in volume from 445 contracts to trading no volume in the week, and also with sorghum, which traded from 16,865 contracts to trading no contracts in the week under consideration. With regards to the price changes on the exchange, the top gainers were ginger, which went up by 31.78% to close the trading week at 127,362. And Ladi, I must say that ginger contract that you claim to buy, I'm pretty sure it's doing quite well right now. And also with cashew nut, which went up by 0.94% to close the trading week at 44,917 naira per contract. With regards to the losers in the week, we had paddy rice, which fell by 6.02%, closing the trading week at 20,650 naira per contract. And we also have maize, which fell by 3.32% to close the trading week week at 19,200 naira per contract. And last but certainly not least, we have the fair trade exchange traded commodity, which is the FETC, which fell by 3.32% to close the trading week at 13,236 naira per contract. So that's by and large all of what happened in the exchange in the week under consideration. And as we always say, if you want to know more about the commodities market, you can always go to our website, which is www.afxnigeria.com. And if you want to get started trading commodities, whether that's spot contracts or fixed income products, you can always download our app, which is available on iOS and Android.
All right, Michael, well, I'm quite bullish on ginger, but your cashew nut got me curious here. Its price was up almost 100%.
Cashew nut?
Yeah, I thought I saw cashew up about 100% there.
Cashew is up 0.94%, correct me if and you close your trading week at 44,917 naira per contract.
Okay, that's
so
0.94%, right.
Yes, 0.94%, Ladi.
All right. Well, but all right. What is? Let's look at another thing now. AFEX is also concerned about building food reserves. Okay. How can Nigeria have enough food reserve as a country and as a continent? How do we ensure we are actually food secure enough to survive, especially in the event of a crisis like we did with COVID-19? So what is Nigeria's 2021 food reserve in comparison to the 2020s?
So thank you, Ladi, very much for that question. I think the food reserve / food security question is a very important one and a very important question that we need to answer. As regards what the concrete numbers are for this year, we don't really have much, but this is what we do know from the data that is available. We do know that the federal government procures approximately 20 to 40,000 metric tons of commodities on any given year. We know that usually the average is maybe slightly higher to about 50,000 metric tons of commodities in any given year. But we don't really have any concrete figure for what the numbers are this year. We do know that last year the federal government released about 70,000 metric tons of commodities as a buffer against the effect of the COVID-19 crisis. There was a bit of rumor in the second quarter of this year as regards whether or not the federal government would be procuring commodities, but there wasn't really anything concrete happening as a result of that. We did also have the strategic maize reserve, which was an initiation by the central bank last year to sort of provide a price control for maize prices and for maize in the commodities market, but that's more of a price control thing and not really a food reserve thing. So as regards what the real concrete numbers are for this year, we don't really have any concrete figures yet in comparison to the previous year. But we do know that they procure approximately 40 to 50,000 metric tons in any given year.
So what are some of the challenges? Obviously, we know when we talk about food security in these days in Nigeria, we have the issue of insecurity. But what are some of the challenges that affect the level of food buffer that is available in the country?
Thank you very much. So broadly, there are three major issues when it comes to providing buffers. So first is the capital / cash issue. So the federal government allocation to the agriculture sector, and that would be the Federal Ministry of Agriculture and Rural Development, has historically been less than 5%. In the year 2019, that number was about 2%. This year, 2021, there are rumors that the figures would be around 200 billion. Now, let's do a bit of a mental math here, right? So let's say that is the entire 200 billion is what would be used to procure commodities as an attempt to provide a food buffer, right? And let's say that the only commodity that they are procuring would be maize, which of course the average price per metric ton is around 150,000. What that would mean, if you divide the 200 billion by the 150,000 metric tons, you would essentially have a figure somewhere around 667,000 metric tons of commodities for maize alone, which is nowhere near what the consumption numbers are for the country, which is usually around 10 to 11 million metric tons of commodities. That's problem number one. We don't have enough cash to buy enough of commodities for us to actually have those buffers put into place. The second would also be storage capacity. So currently we have a national storage capacity of around a million plus metric tons, right? For a country that produces around 193 million metric tons of agricultural produce across board, that represents about a 0.5% absorption capacity for what we currently produce as a country. For the United States, which is a developed country, that number is much higher. It's 78%. For our neighboring countries in South Africa, that number is also much higher. It's 83%. What this essentially means is that they can afford to store a significant portion of the amount of commodities that they produce on a year-on-year basis, meaning that they have the ability to absorb that a significant portion of that volume on any given year. The third problem with the third challenge would also be efficiency. Historically, the federal government has not been known to do particularly well across the entire value chain of the agricultural sector, and that's from cultivation to aggregation to storage and then to eventual delivery. What we believe to be the next steps here is a bit of a public and private partnerships whereby private institutions are sort of engendered to provide services as it concerns storage and providing buffers. So for us at AFEX, we've already made significant progress in more than doubling our current storage capacity. We are providing an additional 100,000 metric tons this year. We're also the first company to provide storage as a service and also the largest single private storage provider of commodities in the country. So we believe these three things, cash, storage infrastructure, and also efficiency, are three things that need to be solved as regards to challenges that are facing our ability to provide food buffers.
All right, Michael, that's great. But what structures can we put in place to ensure that we have enough to survive as a country and as a continent?
So broadly, this would also be three, right? So the first would be for us to significantly improve our yield and production. And that would essentially be two things, right? First, by increasing the quality of seeds that we give to smallholder farmers to help them increase their production capacity, and also with the inputs that we give to them. With regards to the seeds, if you take rice as an example, and if we double the current production capacity, we would essentially be a net exporter of rice as a country. And also with the inputs, there is a need to control the prices of fertilizers across board, because the prices this year are almost twice, if not more than twice, what the current prices were last year. So these are some of the controls that need to be put into place as regards increasing the production of the country, for one. The second would also be for us to actually significantly increase our storage capacity as a country. And that can either be done by building warehouses close to where the smallholder farmers are in rural locations, so that we can facilitate a last mile interaction with them, or also by building silo storage facilities across major urban areas, so that we can service processors that need these storage facilities. So we believe that could also be the second infrastructure that needs to be put into place. At least that number needs to be significantly higher than the current 0.57% that it currently is. And the third would also be our ability to leverage financial market products like e-warehouse receipt financing and also futures contracts to sort of help provide a very good capital efficiency. And what this essentially means is that we don't, if we leverage these financial market products, we don't necessarily need to buy 100% of the commodities that we're trying to provide buffers on. We can essentially leverage forwards and futures contracts to sort of help us provide a better capital efficiency.
But seeing that the world has gone digital now, thanks to COVID-19 and other factors, what has technology, got to do in this solution that you prefer?
The most important thing with regards to technology would actually be data and our ability to use that data effectively. So first off, as I've alluded to in previous time, we need to be able to predict what the year-on-year production numbers would be. We need to be able to predict by virtue of what the smallholder farmers are cultivating per time. We need to be able to predict their yield levels so that we can know whether or not we are at a significant risk of a food production deficit in any given time. And it's also the case that we need to be able to leverage the current data that exists to sort of predict what would eventually happen in the future, whether that's by looking at weather and rainfall data to sort of help predict what the production numbers would be, or also by looking at those data to sort of help us provide a buffer against when there's a significant weather calamity. So I think for technology, with regards to providing buffers, I think that's where technology would play a significant role in helping us provide a buffer.
All right, Michael, thank you so much for the solutions you prefer, and I do hope that it will go beyond discussion into being practice, and then we will have a food reserve in the country. Thank you so much, Michael Martins, Portfolio Manager at AFEX, for sharing your thoughts with us, and enjoy the rest of your day. So we'll do an opening call now to the markets. The all-share index. The all-share index did close flat yesterday. Will we give us the details right after this break? Will is standing by. She has the details from yesterday's market. Hello, Will.
Hello, Ini. Good morning. Oh, yes, like you mentioned, the market closed flat in yesterday's trading session, and we see that the all-share index, and that made that took the all-share index to 37,857.24 points. It seems investors see the need to reconsider buying positions on the NGX ahead of companies releasing their first half financials. Some investors seem to be cherry-picking attractive stocks. We see that, as we talked about, is flat. Equity cap is still at 19.724 trillion naira, and value things are just moving on as it is, where volume was up yesterday by 5.4% to 197.27 million units. Value was at 1.29 billion naira, and all transacted in 3,500 deals. We have Kayode Layemi on the line to tell us more about what's happening there. Good morning, Kayode.
Hi, good morning, Will.
To give us an insider perspective on this, Kayode, we've seen the downtick in the equities market. In particular, I'm interested, and I'm sure most investors are interested to know what's going on in the industrial counter. We see that it was flat. Basically, it was flat and unchanged for some time now, and there's been no movement, most especially in Dangote's shares, which has remained at 230 naira since July 2nd. Also, taking into consideration the SEC's recent approval for renewal of Dangote Cement's share buyback program. Are investors reacting to this? What's the market telling us?
Okay. First, for a bit of context, remember last year the SEC had approved the company's share buyback program, in which they were to purchase about 10% of the shares outstanding over a 12-month period. At the expiration of that, they had only purchased about less than 0.5% of the shares outstanding. Hence, they went back to the SEC to get the approval renewed. When the transaction happened last year, the company did not start buying shares until the last few days of the year. And the sense is that that's what market participants are expecting again, that the transaction will go the same way. So that's probably why we're seeing the muted reaction to the counter. But I think that the smart money is already positioning in the stock, given that the stock is already up about 12% from the year low. So I think that's pretty much what's going on there. People are just sort of waiting for when a transaction probably comes to life towards the end of the year.
Thank you so much, Kayode. That was Kayode Olayemi, stockbroker at CSL Stockbrokers. We move over to the OTC market, where the NASD Securities Index and market cap was up at 0.12% yesterday and taking it to 762.02 points. The market cap was at 541.65 billion naira. Investors gained about 63 million naira in yesterday's trade. However, there was a slump in the total volume of securities traded, but down about 22% to 1.9 million units. Value went down also to 37,009 million units, and it was all transacted in 23 deals. Newest, ASL Nigeria and Double One PLC saw increases in their share price, up by 10% and 7% each. But at the fixed income markets, we see that the bonds traded was bearish. We saw average yield increase by 11 basis points to 11.6%. And across the benchmark curve, average yield rose at the short and the long ends due to sell-offs of the April 2023 bonds, and also at the mid section, where yield for the mid-tenor bonds closed, whereby the yields for mid-tenor bonds closed flat. Also, there was market action seen on the 2024 deals. Meanwhile, the investors are expecting a rollover of over 500 billion naira bond maturities this week. And in the treasury bills market, there will be an auction today to mop up over 109 billion naira treasury bills maturing on Thursday. That's so much liquidity coming into the system, hopefully to outweigh the bearish sentiments currently being observed. And we have Choma Udu on the line, a fixed income dealer at GT Bank, to tell us what's going to happen today. Hi, Choma.
Hi, good morning. Thank you for having me.
Good morning. It's good to have you too. Choma, seeing that the DMO is watching its cost of borrowing, especially to fund the recently approved supplementary budget of 895 billion naira, do we expect to see yields drop in the bonds, possibly to the 9 or 8 levels?
Well, we have mixed reaction. A couple of the fact that the federal government intends to borrow more. We have 601 billion expected to come in for bond maturity and couple payments tomorrow. So there's liquidity in the system. DMO is, for the auction, we have 109 on offer across key tenors. And what we expect today is slight moderation in rates. And we also expect that DMO would try and take as much funds as they can from the auction today, especially after 1 year maturity.
So you're saying what are your expectations? Could you be more specific about what we should expect in the auction for the NTB auction today?
What I expect is slight moderation of the 1 year, which is currently the last top rate was at 9.15. So we expect that it's going to moderate a little. The rates are going to drop a little in that space. But we expect that DMO will take more than is on offer.
Thank you so much, Choma. That's Choma Udu, a fixed income dealer at GT Bank. And that's what we have for you, Edie. No time to give you more details, but tomorrow is another day.
Sure, tomorrow is another day, and we hope by then the auction will be over and we'll see the results.
Definitely.
At the end of today. Thank you so much, Will.
Thank you, too.
Well, we'll take a break now. When we come back, we'll do an opening call to London. Just stay with us. You're still watching Business Morning on Channels Television. We head over to our London studios now to get updates of what's happening in the UK. Hello, Juliana. Good morning.
Good morning to you, Winnie.
Yeah, so inflation is up in June, the highest in almost 3 years. What are the drivers?
Yeah, it's a pretty high rate of inflation coming in at 2.5% in the month of June. This follows an increase of 2.1%. As you said, this is the highest level of CPI in the UK for 3 years, and it's the third consecutive month that it's risen above the Bank of England target of 2%. I think the general consensus around the central bank as well as central bankers across the world is that this is transitory, that it will peak possibly at 3% by the end of the year and go back to its natural levels. However, there are, of course, opposing views. One of them, well, the loudest voice really is coming from the outgoing chief economist of the Bank of England, Andy Holden, who believes it would likely reach about 4% here in the UK. I think one of the biggest striking factors is that, of course, this year's prices are being compared to last year. And we know that last year we were in the peak of the pandemic and prices were depressed as lots of services that were in lockdown were trying to get customers into their stores, and they were putting prices down. Of course, this isn't the case now. There's so much pent-up demand that prices are surging, particularly fuel levels, food levels, the cost of petrol, as well as the cost of second-hand cars.
Yeah, and with the shortage of chip globally now, people are turning to second-hand cars, but even that is recording a hike in prices.
Well, absolutely. The semiconductor chip shortage is a massive story. Lots of car production companies in the UK have actually had to shut down because they just can't produce them fast enough. This goes way back to the spat between Trump and Xi Jinping, and that's really affected the distribution of chips, as well as, of course, the supply chains and the blockages that are still taking place because of the pandemic and because of some of the shutdowns at ports. If you were to have purchased a Mercedes-Benz, for example, let's say a C-Class, in January, you probably would have spent about £14,500. If you want to buy one today, it's going to cost you £17,500. That is the reality of the increase of the spike in second-hand cars. We're also seeing this across the pond in America. Yesterday, we got their level of CPI. I believe it came in at 5.4%. That's the highest level of CPI in America for 13 years. And again, they are seeing a massive surge in second-hand car prices. So it is a big cause for concern. Again, the central bank policy is that this is going to be transitory, but certainly it hasn't stopped a lot of people talking about inflation, and it is likely to dominate the second half of the year when it comes to economic discussions.
Yeah, and yesterday we talked about masks for transports in the UK after July 19th, and we're hearing now that even though in England it's not compulsory, in London you still have to put on your mask even after the 19th of July.
Yes, so many mixed messages. A lot of people very, very unhappy with Boris Johnson, the Prime Minister's government, for sending so many mixed signals. On the one hand, they've confirmed that it isn't going to be a legal requirement to wear masks. Some people think that's absolutely bizarre, and Britain have become an outlier where there's so much scientific advice that does prove if you are wearing a mask in a crowded venue, you are less likely to contract COVID-19. And the cases here in the UK are 15 times higher than they were just a month ago. That's 15 times higher. So there are concerns, so much so that Sadiq Khan, the Mayor of London, he has confirmed this morning that it will be a requirement, not a legal requirement, but a requirement within TfL. So if you're travelling in London, no matter who you are, unless you're exempt, of course, you must wear a face mask on public transport. Public transport levels are currently, underground at least, about 50% of where they were pre-pandemic. Buses much higher, about 60 to 70%. So that's the rules. However, of course, you've got one thing coming from central government, one thing coming from the City of London. So we'll just have to wait and see. But I've got to tell you, there are lots of concerns about this mass opening, considering the fact that Britain is one of the only advanced economies in the world to take such a measure, when we know that cases could rise to about 100,000 a day. So we'll have to watch and wait and see if the government have to do one of their miraculous U-turns, which they've done so much so in the past 18 months.
Well, it really sounds scary, Juliana, 15 times higher, you know. So please just try and stay safe and put on your mask and do all that you have to do, but do stay safe.
I will. Thank you, Winnie.
All right. So we'll take a peep into the crypto market. Bitcoin still on the downward trend, not looking, well, I think my prediction is coming to pass, and then we'll start seeing an upward trend.
That's after I hit your prediction.
Yeah,
okay.
yes.
All right. Anyway, I was expecting a dip yesterday, but it actually happened this morning. Bitcoin is in the red with a couple of major altcoins. Only the stable coins are actually in the green this morning. Let's bring in Solomon Amundo. Hello, Solomon.
Good morning, Laddie. Good morning.
Good morning, Solomon. So our report says about trade volume on major exchanges dropped by about 42% in June, you know, compared to May. What does this signal tell us?
Actually, it's nothing to be worried about. I think the factors are actually what's caused this. We found out that in the month of June we had serious market correction. That was one major thing that caused the trade volumes to drop. And this month, July, China has been cracking down on their miners, and it's been really, really serious. Since last month till now, they're still really cracking down on the miners, and we have noticed that most of the miners have left China. And although they haven't sold off the Bitcoins they've mined so far, they haven't sold them. And also, I still feel, based on the last liquidations we had last month in the market due to the short-term bearish market, it's really made so many questions.
All right, seems we lost Solomon there. Anyway, looking at the 1 hour chart here, we see Bitcoin had that big drop all the way to about $31,910. It broke below the simple moving average on the Blinger band, and it is trading below the MACD bullish region there, and we can see the RSI. RSI is actually oversold on the 1 hour chart, so we could maybe see some kind of bounce there. Price of Ethereum, $1,880, down 6.36%. 24-hour volume, 16.89 billion. And a couple of analysts out there saying that at some point, Ethereum is going to flip Bitcoin. I don't know how that's going to happen, because right now it's trading at $1,000. That would take it over 30K. That's quite an incredible projection. Top odds by market cap. We have Binance Coin there. BNB down 6%. I think we have Solomon now. Hello, Solomon. Hello, Solomon. Can you hear me?
Yeah, I can hear you now.
Okay. Yeah, another thing, you know, traders keep expecting Bitcoin to, you know, either drop or go up. Wouldn't we get to a point where Bitcoin is, you know, quite stable, you know? Can we just say maybe 30K is a fair price for Bitcoin?
So currently, 30K is not a fair price. But yes, we'll get to a point where Bitcoin becomes more stable than it is today. But we are not yet close to that time. And long term, Bitcoin price is still extremely undervalued for those buying the assets for long-term sales. But for the short-term traders, it seems fairly even, although working with the last 10 years historical analysis of Bitcoin price, we're looking at it getting to a science 150K. That's why many traders are much optimistic that we are still extremely bearish at this point. So
right.
If we close above 100K, that's when we would feel the price is on a fair valid for this year.
All right, but quickly, before I let you go, do you think Ethereum is going to flip Bitcoin?
Long term, I don't think so. I don't think Ethereum will flip Bitcoin. Why? Because yes, Ethereum is a blockchain that houses so many DeFi projects and NFT code projects. At the same time, we are having so many other new blockchains springing up. We can see Solana, which is doing very, very well. We can see the Binance Smart Chain, which is also doing very well. And we have Avalanche and so many others. So long term, I don't really think Ethereum will flip Bitcoin.
All right, Solomon. Always great to talk to you. Thank you so much.
Okay.
So, looking at the top odds by market cap, we see Doge is falling below the 20-cent region. Now it's down 6% at 19 cents, and we have XRP at 59 cents.
Well, there's something you asked there about Bitcoin being stable, getting to a price where it's stable.
What's wrong with that?
And I'm wondering, when it gets stable, is it going to be an attractive investment?
Yeah, well, it can just be used for transactions then, maybe not investment.
So it will not be an investment anymore.
And a hedge against
inflation. That would be a boring Bitcoin. We don't want Bitcoin.
Oh, you like the violent swings.
All right, that's it on the program today. Thank you so much for being a part of it. I'm Ini John Mekwa. Do remember that 1:30 Business Incorporated will be on with more updates from the business world.
Thank you so much for watching. I'm Ladi Williams.